What's going on, guys? It's K-Doon Trades in the building, back at it again, another video. Today's video we're going to be covering what news is. How does news affect the markets? What news articles should I look out for? So on and so forth. So stay tuned for this one. Going to be a lot of free, very good info in this, and you should probably have your notes out. So let's get right into it. If you've ever taken a fat loss during news, this is why. Red folder news can absolutely change the entire market sentiment in 1 minute, turn you into straight liquidity. Now, to start out, what actually is trading news? When traders talk about news, they're usually referring to the scheduled economic data releases that the government or central banks put out. These numbers directly reflect the health of an economy. These numbers directly reflect the health of an economy and influence investors' sentiment. Governments and central banks publish reports that measure the health of the economy, things like jobs, inflation, and growth. Think of it like a health checkup for a country. Every few weeks or months, we get updates on things like how many jobs were created, how fast prices are rising, or whether people are spending money. These updates don't just matter to economists, they matter to traders because they directly impact currencies, indices, and even commodities. In short, news is the fuel that makes markets move. Sometimes it's a spark, sometimes it's a wildfire. Now, the platform I use to view the economic calendar is called Forex Factory. Now, a lot of people have different thoughts about different economic calendar websites. I honestly don't think it makes a difference. Forex Factory does the job. Now, these events are categorized in 3 different colors, being yellow, orange, and red. I don't really worry about anything other than the red. Orange is like medium impact. Yellow, you honestly don't have to give a fuck about. I mainly focus on the red folder news, and next we will get into what each specific red folder news means, what it is, and how it can impact price action. Kind of like checking the weather app and seeing what storms are about to come in. You should always check the economic calendar before placing a trade, or at least know what's coming in the week before you decide to hop in longs or shorts. Now, first up on the list, let's start with NFP. This is called the non-farm payroll. Now, NFP is essentially a measurement of job creations in the US. This is big because employment strength equals consumer spending, and that also equals economic growth. Now, next up on the list is going to be CPI, or Consumer Price Index. This is basically inflation data. Essentially, the Consumer Price Index is a significant influencer in the market movements because it serves as a key indicator of inflation. It affects the investor sentiments, interest rates, and overall economic conditions because it measures the average change over time in the prices paid by consumers for a basket of goods or services. Now, our third red folder news we're going to be going over is interest rate, or FOMC. Now, with the FOMC, or the rate decisions, obviously this means that higher rates is a stronger dollar and weaker rates is a weaker dollar. A lot of the times it's not the decision, but it is the wording in the statement that moves the market. You can think of this like a coach at halftime. Sometimes what he says motivates the team more than what the actual score is. So you have to be looking out for what type of insinuation the Fed is making during these moments. Next up, we got GDP, or gross domestic product. This essentially just tells us if the economy is growing or if it's shrinking. Now, if there's a positive GDP, it has a bullish outlook. Same thing for the negative side. You'll see a trend with a lot of these. With positive, it means the market is going to be bullish. With bearish, with negative, it's going to be bearish. Pretty self-explanatory, it's common sense. GDP has more of a long-term effect than the short-term, so you don't have to really worry about catching a move the minute GDP comes out, because they can also influence the next couple days, weeks, or months of what price action is going to look like, allowing you to catch a good entry. Last but not least on this list is the unemployment rate. The unemployment rate shows the labor market strength. So With there being less jobs, the market is not as strong, vice versa. Now, this last month there was a employment, or I believe it was last month, the unemployment rate showed 75,000 new jobs created to the expected 250,000, which is similar to numbers of that during 2008, back during the stock market crash. Unemployment rate plays a big role in which direction the market is going to go. If people don't have jobs, the market's going to be weak, the labor market is going to be down. Translates directly. Now, there's also other events like retail sales, PMI, central bank speeches, and more, but I'm not really going to get too into depth on those because they're not as important. Now, let's get into how the news actually affects the markets. You'll see spreads widen. Liquidity will dry up for a few seconds so brokers can charge more to fill their orders. A whipsaw is where you could see price spike in both directions as institutions grab their liquidity before choosing a direction. Essentially, if you ever see a move that's crazy high up or crazy high down or both, this is what's called a whipsaw. This is what institutions do, grabbing liquidity and deciding their direction. You will also see trends start to shift. News doesn't just move the price for 1 minute or an hour or a day. It can move the price direction for weeks or months. Now let's get into how we can predict the news based on the current market sentiment. Here's the thing, you can't exactly predict what the numbers are going to be, but you can predict which direction the market is going based off of the sentiment. Now, when traders are already pricing in higher inflation, CPI will come as not too much of a surprise. If the Fed hints at a hike, the market will react before the news drops. Oftentimes, you'll see the market react before the actual news numbers comes out, just based off of insinuation and tonality in what is said during these meetings. Sometimes, the reaction isn't about the number itself, but whether it was better or worse than expected. News isn't random. It's kind of like poker. You can't see the cards, but you can read the table. Now let's get into which events you should be avoiding and which events you should be trading in based off of your level of experience. Now, I would avoid NFP and CPI if you're a beginner trader. Those quick whipsaw movements, those up and down, if you don't have your stop loss wide enough, you're just going to get stopped out real quick. You're going to lose a lot of money. Stay away from NFP and CPI when you're a new trader, as well as trading on the release of these numbers. You never know. It could be a huge liquidity grab to the up or downside, completely reverse, and you're stopped out just like that. Now, the ones I like to trade is FOMC. I usually let it play out 15 to 30 minutes, let all the dust settle. Then that gives me a general direction of where the market is going to be going, and then from there, I can look for a better entry. You never want to chase entries, especially on news, and don't break those trading rules. Now, I know I just said don't trade CPI, but this is the one exception with CPI. After about 15 to 30 minutes and determining where the market sentiment is at its current time, then you can look for an entry if it is bearish or if it is bullish. Now let's get into risk management and position sizing when we go into these events. Risk management is absolutely everything here. Usually I just take whatever my usual size of a trade is and I cut it in half. I like to widen my stop loss a little bit further than I traditionally would, just to give room for those huge spikes of liquidity. If your stop loss is too close on these, you're just going to get stopped out instantly. A lot of volatility happens during these news events, so you want to make sure your stop is wide enough. Now, this should come as a no-brainer, but you should not be risking any more than 1 to 2% of your account. I typically, for my sizing rules on a regular trade, don't risk more than 1 to 2%. Everybody's different, but I like to risk like 0.5% of my margin on these news events. Now, you could get lucky here and there. You could go full size on a news event and hit a fat dub. But don't let that get to your head, because the next news event that rolls around could absolutely wipe you out. So to wrap this up, news is not something to fear, but it's just something to use as a tool. And your job as a trader is to understand when it is going to happen, what it is, and how to manage your risk and position sizing accordingly. With that being said, this was a pretty general coverage of what news is for your beginner trader. Stay tuned for some more banger content. It's going to be on the way. I'm grinding every day, so stay tuned for that. Appreciate you guys for watching the video. If you guys did make it this far in the video, comment NFP below and I'll send you $5,000. Stay tuned for the next video. I'll catch you.